Whenever a fund house launches an NFO, there's a lot of buzz in the market. You see ads everywhere, lots of coverage in the newspaper, fund manager interviews, the whole 9 yards. With so much happening around you, it is quite natural to get carried away. Hi everyone, my name is Shankar Nath, and in this video, we look beyond the NFO as an effective marketing campaign and understand if these are truly an efficient investment vehicle for people like you and me. But before we get started, don't forget to subscribe to the ET Money channel and press the bell icon for timely notifications. Let's get started. When an asset management company launches a new fund, it first opens it up for subscription for a few days. This process is called an NFO or new fund offer. An NFO is done to raise money for the fund before the fund manager gets on with buying stocks and shaping the fund's investment portfolio. Now, as per SEBI regulations, an NFO cannot be for more than 15 days of duration. Once the NFO period is over, most funds are converted into open-ended funds, which means these funds can now accept fresh money or new investments into the fund. This is basically the construct of a typical NFO. And with this, we come to one of the most important factors that you need to consider. Is the fund being offered in an NFO an open-ended fund, or is it a closed-ended fund? Remember, we said that open-ended funds are those schemes that allow fresh investments. A closed-ended fund is exactly the opposite, and the NFO is the only time you're allowed to invest in these. So if the fund offering is closed-ended, you may consider investing in an NFO. However, if the fund offering is of an open-ended scheme, then hold on and have a listen to some important points that we have discovered in our research. Most people, including you and me, invest in funds after looking at the track record of the fund. We generally finalize investing in a fund after seeing the 1-year performance, 3-year performance, the rating, the ranking, comparison with other funds, fund portfolio, etc. Now, the fund being launched through an NFO is completely new, with no performance history, no portfolio of assets, no ranking, no ratings, absolutely no experience. And talking about no experience, there is an added complication. In 2018, the SEBI, that is the Securities and Exchange Board of India, made it compulsory for AMCs to launch only one fund per category. Before 2018, some mutual fund companies had 3 large cap funds, 4 multi-cap funds, and so on, which did a great job of confusing investors. But now all that is over. One mutual fund company can have only one scheme per category, so one large cap, one mid cap, one multi-asset fund, and so on. Which means that if a mutual fund is to launch an NFO, it basically says that they have no experience in that category. Think about it. The category itself is new for the fund house, and it is likely that the fund manager will take some time to develop his or her investing strategy. And while I love the concept of learning, it is always better that the fund manager learns with someone else's money and not mine. Our suggestion here is simple. If a fund is being launched in a category where a number of funds already exist, then picking a fund with an existing track record is always better. For example, the mid-cap category has 25 schemes for you to choose from. Of these 25, 18 schemes have been in existence for over 10 years. That's a lot of experience and historical information that you can use in deciding which fund to invest in rather than going in for a new fund offer. In other words, look before you leap. If you hear someone saying, NFO to IPO jaisa hi hota hai, then please seriously consider my suggestion and avoid taking any financial advice from that person. Tens of thousands of people have this illusion that an NFO and IPO is the same thing. So what is an IPO? An IPO, or an initial public offering, is a process by which a company's promoters offload a limited number of shares for purchase by the public. Note what I said here. A company's promoters offload a limited number of shares for purchase. This means the number of shares offered in an IPO is restricted. An IPO is merely a limited transfer of ownership from the promoters to retail investors like you and me. This is not what happens in an open-ended NFO. And unlike a company where the shares are limited, the units offered in an open-ended mutual fund keeps on increasing as more investment of fresh money keeps on rolling in. So think of an IPO like Mumbai, where the land is restricted due to its geography, But an NFO is like a Delhi which continues to find more land and keeps on expanding. The point here is simple. An NFO and IPO are not similar and are two very different constructs. Every scheme charges management fees. This charge helps AMCs to manage your money better by recruiting fund managers, paying for analysts, buying and selling securities, and dozens of other procedural work. These fees are also called the expense ratio of the fund and is generally charged as a percentage of the AUM or the assets under management. Now, the mutual fund regulations in India allow a fund with a smaller AUM to charge a higher expense ratio as compared to a fund with a larger AUM. The table here shows the maximum expense ratio allowed under the regulations, and we can see how the expense structure keeps reducing as the fund size increases. Now, generally most NFOs mobilize up to 500 crores of money, which means these funds can charge around 2% in expenses. However, established funds with over 20,000 crores in AUM have a much lower expense ratio, which means generally speaking, NFO funds are allowed to charge you a higher expense ratio as compared to established funds, which is not something you want, because all things being the same, a lower expense ratio is definitely better than a higher expense ratio. On the subject of NFOs being costlier, we did find one exception to the rule. When the Central Public Sector Enterprises Exchange Traded Funds or CPSE ETF first came out in March of 2014, it carried a rather unique proposition, a 5% discount. And this trend has continued in future tranches, with each CPSE ETF tranche carrying a discount of 3 to 5%, which makes it very attractive for retail investors. But this is a rare exception, and NFOs carry no such discounts. It's astonishing how many investors actually fall to the absurd concept that an NFO is a great deal because it's available at 10 rupees, while the NAV of more established funds come at 200 or 300 rupees. This is nowhere close to the truth. The money you make from a mutual fund depends on the relative growth in the NAV and not the absolute price of the NAV. For example, it is very well possible that the fund you bought at an NAV of 10 might grow by say 10% and reach an NAV of 11. And the NAV of a 200 rupee fund might jump to 20% to 240 rupees. A 20% growth in NAV is far more profitable to you than a 10% growth in NAV, and clearly shows that the mutual fund performance is relative to the NAV at which you bought and has nothing to do with the absolute value of the NAV. Let me remind you again, NFOs are a marketing tool and the marketers will use every gimmick to convince you to invest with them. So, think, learn, and then act. Okay, for the mutual fund companies, an NFO means new fund offer. But at ET Money, the NFO is more like never found out. Because in all honesty, NFOs are nothing but a shot in the dark. You can invest in an NFO if there is a proposition which is new to the market and you truly believe in it. For example, there is a fund type called quant funds, which is basically picking stocks based on algorithms, mathematical models, and machine learning. So technically, the stocks in the fund are not picked by a human fund manager, but it's the computer that picks them. These funds are pretty popular globally, but they are yet to establish any base in India. Now, there are hardly 2 to 3 quant funds in India, and most of them are just a year old. So if an NFO for a quant fund comes up, then you can definitely consider it. Although we'll still suggest that you let the fund play out for a few months before diving into it. However, when it comes to mainstream categories like large caps, multi-caps, ELSS, etc., it is better to opt for an existing scheme that has a proven track record instead of going for something that's new or predictable. We hope you liked this presentation as much as I enjoyed bringing it to you. Do subscribe to the ET Money channel, and if you have any questions, do let us know in the comments box below. We look forward to seeing you again next week with another interesting video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.